Good afternoon, everybody. Welcome to Spinnaker Investment Group's virtual quarterly market update. My name is Joe Stapleton. It's a pleasure to be your host this afternoon. And as president and co-founder, we're so appreciative of you making the time to be here. We find that this is part of an ongoing series that we're going to continue to do, this being our second one during this 2020 year so far. So we're excited to continue that meaningful dialogue about investment markets. And we're excited today. We've got over 100 clients joining us and really want to take some time to understand what's going on in the market and really show you guys what we do here at Spinnaker Investment Group and talk about our philosophies and certainly the market update and what's been going on. We are recording this, so we will be posting this on YouTube. So if you forget something or you missed something or you want to go back, we'll probably be launching this on Monday for you to check out live on YouTube. So we're excited for that. Spinnaker Investment Group was founded 4 years ago. Today, we're managing just over $350 million. And the goal is really a couple things. And our value prop here at Spinnaker is really all about education. We feel that knowledge is power. And in a given year like this, with all the noise going on with the election, with COVID-19 and everything else, we really want to help educate clients to make sure they understand what's going on and what our philosophies are and what we see happening out there in the market. And certainly part of an ongoing conversation, like I said earlier, and communicate our philosophy and talk about what we do here at Spinnaker Investment Group. So we're certainly different than our competition. We believe in educating our clients. We feel like an informed client is a lifelong client. We want to improve the overall client experience. We reinvest in technology and a lot of planning tools that you guys have seen recently that we've implemented. So format for this afternoon, obviously, we're going to talk about what's going on in the market, quarterly review. We've got U.S. international stocks, bonds. We're going to talk about the equities, the fixed income portions. We're going to talk about economic trends. We're going to talk about market conditions. We're going to talk about opportunities that we see out there right now. There's a question and answer feature at the bottom of your screen. So at any moment, please click that. I'm happy to interrupt Morgan and ask him questions as we're going through. Also a chat feature if you're more comfortable with that. But please utilize those so we can make this a lively, interactive conversation as well. So joining me this afternoon are my two partners, Morgan Kristen and Andrew Krongold. Andrew Krongold is Vice President here at Spinnaker Investment Group. And he's going to lead us in the close this afternoon. So with that, I'd like to introduce Morgan Kristen, affectionately known as the Wizard here at Spinnaker Investment Group. Certainly somebody that we love to work with, somebody that you love to work with as clients, I'm sure, and somebody that knows all there is about the markets and certainly been doing this for about 27 years now. He's got a CFA designation, a CFP designation, and certainly one of the smartest men you'll ever meet. So with that, Morgan Kristen, the floor is yours.
Awesome. Thanks, Joe. Today, as Joe mentioned a bit, we're going to talk about what happened. So go through the third quarter, areas that did well, areas that did even better, and then go through one of the big things everyone's talking about, the election, the impact on all that. So to get started here, let me go ahead and share my screen. I'm sure I'm set up for that. There we go. And go. Okay. Let's get this thing. Why is it not launching?
This is what happens when you put the investment guy in charge of technology, right?
Exactly. Something, it's going to go wrong. There we go. So to start off, I mentioned that we're going to talk about the third quarter. So third quarter was certainly a good quarter. You look at the S&P 500, up just under 9% and putting us in the positive zone year to date. So that's great. And then also as you look over time, the 1 year, 3 year, 5 year, and 10 year, it's been good to be invested in stocks. Smaller companies, as represented by the Russell 2000, made a good stride back in the third quarter, but are still off just under 9% for the year. International developed stocks up a bit, off for the year, off for the 1, off for the 3, and kind of a tough deal there over the last 10 years being international. Emerging markets, probably a little better in the 10-year, but you'll see really a star here, certainly in year to date, is bonds, and we'll talk about that. As interest rates it went down quite a bit. Bonds did quite well, and then real estate investment trusts, while they're not all tied to commercial, they certainly are feeling the pain of the commercial real estate market, having lost in the quarter, lost year to date, and pretty much all the way down the line. So Let's look back at a 1 year to date. So September 2019 through September 2020, we were actually lagging going into 2020. Manufacturing was slowing down a bit, but we did close out with the decade with about 190% gain, and then of course that big drop into March, and kind of what's happened since then. So that big drop, we also had, you look at the drop and we saw a thing that I'll talk about in a minute, but even on the prior slide, all of a sudden there was a little bit of a bump in consumer spending, and you can see it through this, and it really tracks the employment rate. And when we declared the emergency here, and then the CARES Act, and then all of a sudden the stimulus payment, we saw one thing was an increase in spending, but we also saw an increase in employment. Now looking at the quarter, we did see in the quarter, we saw gold climbing to a high that it hasn't seen since about 2011. As I mentioned earlier, that consumer spending, industrial production went up a bit, and but then also what happened in August, the Fed actually completely changed their inflation target. So in the past, they really targeted a 2% inflation rate. But now they were comfortable with an average 2% inflation rate. So what does that mean? Well, that means that that's why they're very comfortable having rates essentially at zero. So then if we average 2, they're good. So if inflation spikes up to 5%, but then comes back down and it averages 2, they're okay with that. So instead of really pegging it to roughly a 2%, they're very fine with floating as long as we average around 2%. So that's a big change to the Fed policy. Also in the quarter, in September, we saw one of the biggest drops, the quickest drops in many years. And since it's been since January 2000 that we had a correction, which is a 10% drop in the S&P in 3 days. So within 3 days, the market dropped 10%. And so we put a newsletter out earlier this week, and we talked about that a bit. And so you look at, of course, all those folks that were on DraftKings that were buying stocks and gambling and doing all that, buying shares, buying options. And it's really interesting because all of a sudden September happens, and what happens there? Football season started. Did they have time to go gamble elsewhere? And then kids went to school. There's a lot of kids that had those Robinhood apps. So anyway, I mean, who knows if that's why, but it's certainly a big deal that we had such a large drop in September. And for the most part, we made that back, especially because of some of the tech stocks, which we'll talk about in a bit here. So worldwide, investors were comfortable taking a bit more risk on as emerging markets, especially small company emerging markets, led the returns in the third quarter, followed by the more international versus the emerging markets. And then we had the Russell 1000. Those are larger companies, broader indexes in the 3000 and S&P 500. And at the bottom, the lowly T-bill at 0.03%. So looking a little more granular on U.S. stocks, again, the big, large technology stocks are really driving this market. Large cap growth in the third quarter up 13%, but you'll see in year to date, 1 year, 3 year, 5 year, 10 year, just absolutely crushing their counterparts in the value. As a value is clawing its way back on the large cap side, still off 11% year to date, off on the 1 year. But the 3, the 5, and the 10 look a lot better. So major outperformance by large cap growth. And as we'll discuss in a bit, it's really driven by a select few stocks. The international developed, it's somewhat the same story. If you look year to date, we had, although when you look at it here, small cap led in the quarter, but year to date, the story really is talking about those growth stocks, growth over value. Certainly the spread there is rather wide, although these small companies have performed a bit better in the international markets. And then emerging markets growth was a top thing. Small cap a little higher than large cap. And so we're really seeing that break down the borders and across the board, growth is strongly outperforming the value stocks. So looking at countries, and first on the developed, Sweden, Denmark, and Finland leading, with Austria, Spain, and Portugal at the bottom, and the emerging markets with India, Pakistan, and Taiwan at the top, with Hungary, Thailand, and Turkey at the bottom. Reason why we show this is we generally believe in, if you want to invest internationally, if you want to invest in emerging markets, generally buy a fund or something that has a basket of these countries, because you're really not going to know from month to month, quarter to quarter, which is the winner, which is the loser. But also to show here that especially in on the developed markets, that a lot of times the U.S. isn't the top the top country, although from the numbers we saw earlier, there certainly was over the 3, 5, and 10 year. But that when you do start looking at things internationally, you have a lot of different things. There's currencies, there's the whoever's ruling the area. I mean, that goes into your thought process when you invest. And so generally, we believe in holding those more as a fund or an ETF, something like that. So real estate investment trust. So the thing is that there's some out there that actually look pretty good. Some of them do cell phone towers. They do distribution centers for Amazon. And there's apartments, which have done quite well. But in general, the thought was real estate investment trust means commercial real estate. Nobody is leasing it, going to their offices anymore. In fact, Pinterest actually paid $90 million to get out of their lease in San Francisco. So I was surprised they had that much money sitting on the side, but $90 million, they're saying, we don't believe we're going back. In fact, we believe so much so that we've done a calculation that says that we will actually stroke a check for $90 million to no longer lease that property. So, real estate's had a tough run. It's year to date, 1, 3, 5. Although 10 years, if you did own REITs, it wasn't a bad asset class. Rule of 72, if you 7% over 10 years, it means your money doubled, even with the kind of crappy last year. So REITs were definitely a tough area to be in. They still are a tough area to be in. Commodities, for the quarter, if you were in lean hog, silver, zinc, you did well. But anything in the oil world was not a great place to be invested. And you look at commodities over time. I mean, if you see here, 10-year, and this is a basket. This isn't saying gold, because like we said earlier, gold finally is catching a bid. It's done quite well, but really it's been since 2011 since it moved. And a lot of that is fear because of all the money we're printing, which we'll also talk about. But you look over time, and you lost 6% per annum being in commodities. So our belief is that, if you want to have exposure there, you can own emerging markets. You look at some of those markets that, they sell oil, or they have sugar cane, or various things like that. We think you can get a good exposure there versus using commodities as a specific asset class. Fixed income, so bonds. I mean, you look here, rates went nowhere. So from the end of the second quarter to the end of the third quarter, rates went nowhere. They're very flat. Here's where the Fed controls. It takes us 30 years to get above 1%. But as they say, the U.S. is probably the cleanest dirty shirt. When you look in Germany, it takes you 20 years to get positive. So you are indeed giving the money to the government. They're giving you less back in the end. So Germany, Japan, even some parts of the yield curve in UK, they're saying, don't save. In fact, we don't want you to save. We want you to spend. We are going to create a large disincentive, close to 1% disincentive for you to save. And so as abysmal as our rates are, they do look better than a few countries. So interest rates, you get in trouble saying that they're absolutely at their bottom, but they're certainly low. So as this teeter-totter shows, interest rates go down, which they've gone down quite a bit, and bond prices go up. And that's why, as we saw earlier, bonds have actually done quite well. You can have a 30-year bond, and it's done well because interest rates went down. Well, there's also a flip side to that teeter-totter. So we certainly caution investors that have done well in bonds, especially if they're long-term. We're on the shorter end of the curve right now in our portfolios. But if you had a 30-year bond, there's a chance that you could be up in double digits for the year because interest rates went down. Well, there's a term out there in the bond world and called duration. And basically what it's saying is that what does these different levels, 1, 2, 5, all the way down to 30 years, what would happen if interest rates went up or down 1%? So in this scenario, this is saying, what if interest rates went up 1%? So if I owned a 10-year treasury bond that yields 0.7%, what if interest rates went up to 1.7? Well, if I owned this bond or I owned a fund that was 10 years, I would lose 9% overnight. So granted, you can hold it till maturity and no harm, no foul. But if I owned a 30-year, this 30-year at 1.5%, it's not out of reach to say that rates at some point could go to 2.5%. That's only 1% from there. You could lose 21%. So I have a 30-year bond, which I'm getting an abysmal yield on it, and I can lose 21%. Again, I can hold it all 30 years, and I will get my money back, but what's my opportunity cost? If I sat there for 30 years earning 1.5%. So we certainly caution people as rates are very low, making sure that their portfolios aren't too long on the yield curve. Now, let's talk a bit about inflation. You look at things like things that we want, I guess, are pricier. I mountain bike, and I know Joe and a lot of our clients are bike riders, and bicycles are expensive. Just got an email from a client that just listed his bike, sold it in one day, and his bike that he orders now in back order is not going to get it till a couple more months. So bikes are getting expensive, and because we're all out riding now, we're all out exercising, and of course rent has gone up. But on the flip side, things we don't want or need because of the world we're in right now are certainly cheaper. We're not going to hotels, we're not going to conventions, although all of us are wearing have a shirt on and a tie, and Joe even has his jacket on. Most people are not. Women are not buying dresses, so clothing is getting hurt. And of course, airfare. So those are certainly getting cheaper. So with the Fed, we talked about the Fed. Fed is out there really pumping tons of money into this economy. In fact, it's one of the quickest and largest reactions we've seen. So as you look here, this blue line is money supply. So look at that. I mean, the Fed just spiked it. We put a lot of money in. Here's the billions of dollars on this scale. A lot of money in. Okay, a lot of money's flowing in. There's going to be inflation. Sure. Not until we see this move. This is what they call the velocity of money, which is only at about 1. Velocity of money means if I buy a car from you for $100 and you take that 100 and you buy something, that $100 can turn into 400. That's velocity. There is no velocity on money right now. Wage growth has been abysmal since 2000. And so the velocity of money is right there. It's not there. If we start seeing this move up, we have a problem. So with this money supply and a turn up in velocity, that spinning of money, that spinning, $1 creating 4, 5, 10, 20, then we have a problem. With all of the money that the Fed has poured into this economy and this moving up, we will absolutely have inflation. However, and granted, I'll give a caveat, kids in college or healthcare, I get it, it's expensive and some food is, but overall, inflation is not here. And I would say yet, it certainly could happen here when we see that velocity move. So the election. Tons of numbers, doesn't matter what it is. All I'm doing here is showing that all in different scenarios, Republican, Democrat, markets have gone up, markets have gone down. And sometimes it's better in the election year for some groups. Sometimes it's better in 2 years out, 3 years out. But overall, the markets have done what they've done. One of the biggest concerns, and a lot of people say, well, gosh, a couple months ago, the market didn't like Biden getting in, rates were going up. I would say Kamala Harris is tax plan, there's no way in its current form would be allowed to be passed through. So now the market is kind of changing a bit. So interest rates are moving up a bit because, I think the thought there is that Biden is leading in the polls, so he may spend more on infrastructure. But really, when you look at historic marginal rates, they've been higher. And the market is also, when we look at people taking positions, we're seeing things in solar, like there was an ETF, it's symbol TAN, that's spiked up. So people are making positions, but based on that earlier chart, the market has done what it's done, regardless. Some people start making bets beforehand. But looking here at the Dow Jones from 1900, so okay, the big talk is, well, what if there's a blue wave, a Democratic president, a Democratic Congress? Well, that happens about 33% of the time, and the market has averaged 7.2%. The flip side, Republican president, Republican Congress, that's happened 23% time, 7.3%. Negligible difference. Really, a lot of times the best is you get a Democratic president, like Congress, that's usually the best. Doesn't happen a lot of the times, but ultimately, you can sit there and go through all these scenarios, and I can present all that stuff, but the market's really going to decide. The market right now seems to be, as far as where money is flowing, it's going to Democrats and Republicans. I don't think the market is so much concerned with who's going to win. I think the biggest concern of the market is uncertainty. So today, earlier in the day, the market sold off because there's no stimulus yet. And I think also the market might be concerned with a contested election. But overall, our belief is do not make decisions based on who's going to get in or who's going to win, because the results are certainly mixed. And you look over time, regardless of who's in, the market has marched forward. It's gone down, it's gone up. We look at Democrats versus Republicans, some up, some down, and ultimately the market keeps moving forward.
Hey, Morgan.
Yeah.
Jared's got a question. If you want to go back to that slide, he's asking if it is a contested election or delayed results due to mail-in voting, whatever, et cetera, what would your advice be as a hedge considering a potential market drop-off? Would you see the scenario as a potential buy at a potential discount? What do you think if it is a contested election?
Yeah, so if it's a contested election, so you go back to 2000, the hanging chads, market went down about 8% from election night to when Gore conceded. So it did go down, and it affected things. My opinion is that it's probably a good time to. It's going to be tough to hedge, but I think a great time to buy. And I think ultimately the market just wants this election over with. It wants to move on. We have a lot, and which we'll talk about. We have a lot bigger things to deal with. One being unemployment and getting people back to work. And the election is yes, there'll be changes, and yes, certain stocks will do well, and there could be some change coming on. But there are, as they say, bigger fish to fry. So looking at the health of this market, so you look at the price earnings. So price of a share divided by its earnings. It's high. Certainly above the average has been for a while, at around 16. And so you look at all the different metrics here, it's somewhat unfavorable. But, as we look at that, really, you look at they call the market, and when you look at the market, it's the S&P 500. 25% of the S&P 500 is basically 5 stocks. And your Facebook, Apple, Amazon, Alphabet, which Google, and Microsoft. I mean, they are a majority of the S&P 500. They're a majority of the earnings. They're also pretty darn expensive, and so they are leading to that higher multiple, as we looked above on the PE at 21 times. And as you look at here are those 5 stocks. They're up phenomenally. I mean, they're up 50%. But let's just look at the S&P 500. Okay, it's up, it's doing well. I think we said 5%. But you take out all these stocks and you just say, where are the other 495? They're down and they're off for the year. And we saw earlier that value versus growth, and some of them are value. And as we look at a few of those, well, actually, before I get into that, but looking at consensus is tough. because if that E gets larger, that'll go into the PE. But consensus is tough in that about 25% of the S&P 500 stocks are not reporting. But right now consensus estimates are looking better than they have been. So again, I went too fast earlier, but value versus growth. On a relative value, this is the baseline. This is when growth looks cheap, and that was there in 15, 16, and it's really dropped down. And value appears to be cheap. But while we don't abandon value stocks, you have to be careful with kind of what they call the value trap. There's some reasons why they're cheap right now. You look at who's in the value camp. Well, you have energy, airlines, hotels, banks. Banks are going to have a tough time with these low interest rates. And airlines, hotels, even if everything went perfect and they had a vaccine at the beginning of next year, it's going to take time for that to happen. It's going to take time for people to be comfortable doing these things. And then you have companies like Microsoft and various others that are going to continue to work from home. So it may be a while before some of those. So, certainly value is not dead. It hasn't done well, but be careful that value trap just because it is completely undervalued. And we'll talk about why, you have to be careful with some tech, but why we like some of the technology and why it is in this new, I hate to say new world, but as we move forward and do things differently. But also on the value side, we're seeing people love the dividends that value provides, and there's still some that pay some nice dividends, but they're cutting in some areas. We're seeing consumer discretionary. We're not buying our Gucci purses anymore, so we're cutting or we're suspending dividends in those consumer discretionary stocks. We're seeing that in real estate, financials. So energy, certainly energy was great. You just buy your Exxon, your Chevron, you clip that coupon, and some of those could be at risk. So that's certainly hurting some of the value stocks. Let's talk about the good in the economy. Core CPI, I mean, our inflation rate is extremely low. And generally that keeps rates low, and that's certainly what the Fed wants to do. Here's what the Fed is, they do their dot plot, and they are essentially saying we are not going anywhere till about 2023. We are not adjusting our rates. So we shouldn't see rates go up in 2021, maybe not in 2022. This is their long run, but you can see the break there. Who knows what the long run? They do want to get it back to 2.5, but that's an unknown. So the Fed is going to keep rates low for a while. Certainly great for mortgage holders or people that can refinance, even auto loans, various things like that, but not great for people with bank accounts or CDs or money markets. So what does that mean now? So I have $100,000 and I have these very low rates. On $100,000, I've left it in my savings account. I made $220. Now, to put that in perspective, just to keep up with inflation, I should have earned about $1,729. So I'm about $1,500 below inflation. So, it's safe. Yes, it's not going anywhere. But I am losing money based on inflation. That's just basic CPI inflation. This would be your education inflation, and of course, medical inflation. So, there's what they call this is really a push or reason why people are buying stocks, and they call it the Tina effect, because there is no alternative really. When you look at rates here, you go, gosh, I may take a chance owning some of these stocks. Yes, it could go up, it could go down, but I possibly have a dividend yield that's even larger than that. So let's talk about that. Here's your 10-year Treasury. Well, U.S. equities, we look at the S&P 500, it's got about a 1.7 yield. I go down here and I get some preferreds at 5, at high yield. So people are going up the risk spectrum. But even buying international stocks, emerging market stocks, U.S. stocks, not guaranteed. They will fluctuate. But back to that Tina, there's just really, if I want to sit here in a 10-year, that's a 10-year Treasury. So you're going to be a lot lower in your bank account. A lot of these certainly look attractive, even if you may say some are overvalued, and some may be. The crowd sentiment. So we like to follow this, and we look at the crowd, and people are certainly they're pessimistic. They're not optimistic, which is generally the retail investor or the small investor is usually wrong. And so we track that, and so right now they're not feeling great, and that's reflected in cash flows. So net inflows into stock, equity, mutual funds, and ETFs has been net actual outflows. People have been selling all the way through here. We saw a couple spikes here, but in general, 2020 has seen money flowing out of stocks and into bonds. So people are very fine earning those very low yields. Now, for some people, if they owned it early enough as rates are going down, they probably made some good returns. But then you look at savings. So our savings rates spiked. So maybe we're taking money out of stocks and doing that, saving, we're putting some cash aside. So that allows people to buy in at a future point, but also shores up individuals' bank accounts and their financial well-being. But then you look at trading. So we've talked about this many times with the Robinhoods and all of those, E-Trade. Back in October, they just all of them slashed commissions to zero, and we saw that massive spike in trading. So that's everyone was a trader, everyone was buying, and that's who were they buying? Tesla, Apple, Microsoft. They were on those stocks have been on fire because they have been the darlings of that group. There was a thing out today that Robinhood had about 2,000 accounts that were hacked because people are on there. So we're seeing somewhat of a slowdown in that trading there. But the zero commission, granted they don't make the commission, but they love you trading out there. They get paid for deal flow, and if you just for trade flow. So they offload that, and they love to see people trading, and it's not good for the market. It's not good for investors in general by trading like that. But they don't think they're altruistic giving you those free trades. They love it. The consumer, we're in pretty good shape right now. So we have financial assets, our homes. So we have a good amount of assets right now. Mortgages are pretty low, but this is of concern. Student debt is growing. That's revolving as credit cards, and so those used to be pretty close to par, but now, we're a lot higher in student debt. I think that there's potentially some changes coming. I mean, you look at, there's online versions like Coursera, companies like that you can do a lot of your stuff online. Google's liking that. They hire people that have done Coursera. I think as someone who has a child in college right now, and they're doing everything online, the pricing model is probably going to have to change. And so hopefully we start seeing some of that go down and dramatic changes in education, which I think needs to happen as far as the cost. But our debt service, we're doing a good job there as a percentage of our disposable income has dropped. So that's healthy. I mean, we like to see that. And then our net worth has gone up. So for the most part, and this is in general, the consumer, and we'll talk about kind of where we bifurcate there, but the consumer's in pretty good shape. Here, just basically showing our retail dropped off the map, but we're starting to shop again, albeit mostly online. We just had the big Prime Day, and so people are shopping again. So let's talk about some bad things in this economy. So you look at the job growth. So after the 1990 recession, high earners versus low, it was all pretty tight. 2001, 2028, but this coronavirus, the highest earners are back, everyone's fine, with the lowest earners really still dropping off. So I put this K here because we had kind of talked about in the past, like more of a swoosh recovery, and it's still kind of like that, but really if you're in the high earn, you're back. And if you're on the low side, you're not. And so we have a kind of a split economy where some are doing well and certainly some are not. And you look at this, and this is a big problem here. So this is our loss of jobs in the last recession, and this is a massive spike here. And although we've done a good job, we still have a tremendous, I think still 11 million people or something like that, just a large number of people that are out of work. And so where that all comes down is that changes in consumer behavior. So those in the top 25%, they've come back, they've started spending again, and you see this spike here. This is back when those $1,200 checks went out, the CARES plan. So those in the bottom are almost back to their spending before the shutdown, but the top. So if you think about that, you live in New York, and you're in a high rent district, and so the restaurant down there, no one's going out. The dry cleaner, so it's going to be a tough thing. The top 25% are not spending any of their money, so it's certainly impacting the bottom 25. So we have an economy where both sides are. There's a complete difference in how things are going. And so, the top 25 doesn't generally spend all their money, but we need consumers spending to keep the GDP growing. It's going to take kind of a concerted effort with everyone. And so we'll see where that goes, and we track on that. But diminishing recession odds, that's gone down a bit, although I think we're still in one. But you look, and they say that it's going to be some time before the labor market gets back. It might be 2023. And again, it's going to take people a while to go back to restaurants. And you can't, all these restaurants that are going to disappear, you can't fire those back up and get things running. We're here in Newport. We're in our own little world. Orange County, you talk to someone up north or something like that where things are shut down. I talked to a guy today in New York, and we're in a different world because we do have things open. We're going out, we're doing things, but across the country, and not nearly what we're seeing. All right, let's wrap this up. I'm talking too long. Basically, I put this out here because those of you that allocated, certainly if you you bought Apple down here, and you bought your Tesla and stuff like that, you're going to outperform most managers. However, what I would say over this time, if you just stay in the market, you keep adding to your portfolio, you're okay. So I put this all up here also because people are concerned with the election and various things that are coming out. Well, we had a pretty big sell-off. We were 30% off on the S&P 500, and we're back. And it doesn't always come back that quickly, but we don't anticipate a drop like that coming up. But certainly we just don't believe you should make decisions based on an election there. So rates will stay low for a while, and then that kind of continue fueling stocks. Inflation will stay low. We still believe in the fourth industrial revolution, this meshing of biotechnology and technology. I've talked to quite a few people who have done their, telemedicine. They met with a doctor on the phone. It's been great. They have monitors, various things like that. So we think that's a continued theme. That doesn't mean you have to jump into some of the high flyers, but technology, biotech, we still think should be a part of a portfolio, that growth side. Elections will come and go, and I think hopefully I've shown you that the markets do what they do. So don't bank on that. An election to me is not as much of a concern as that future spending and unemployment. How do we get those people back to work, and how do we get people spending again? That is of concern to me, and I think that is kind of a 2021 problem. The reason is that we clearly need some kind of stimulus, and I think the market is saying that. But I think whoever is in the White House is going to have some stimulus. But then at some point, when is that over with? So in 2021, we have some kind of vaccine, and people are getting back, and we look around and go, uh-oh, what do we do now? We can't keep giving the stimulus. Where do these jobs go? What happened in commercial real estate? That to me, I'm a more further out, a year out, when I start feeling some concern. The election to me it might be just, I'm hoping, will just be something we look over and go, gosh, why do we get, not a political, just strictly where the market's going. If there's a belief that Biden gets in, international generally is better because of the spending. A Democrat, and some of his plans are he spends more, and so that tends to, or he would spend more, that tends to lower some of the returns on certainly doesn't mean it goes negative on the US, but it helps international. And then, I put a thing here, did you buy in March, a dip in September? A lot of times people are talking about the election, should I get out here? But, I would say, did you buy in March? I mean, so watch for some of those dips. We think it's opportunities. So that is it for me. And so I'll turn it back over to Joe for questions.
Yeah, I'll turn off Turn off the video here. Cool. All right. Yeah. Well, Morgan, what would you say to, I don't have any questions right now, but so for all of our participants, if you want to go to the bottom of your screen, Q&A feature, chat feature, type in some quick questions. I'll ask Morgan a couple questions while we get to that. But Morgan, what would you say? I mean, we get a lot of people that come in our office and they talk about cash. They're sitting in cash right now. I mean, a lot of people got into the market. We had sold off some risk in January, thinking that markets are pretty heavy. Obviously, Black Swan event, March happens, markets get cut 40% in some equities. People kind of figured maybe it'll be a double dip. They didn't get in fast enough. What are your thoughts as far as somebody sitting in cash today?
Well, cash to me is, it really comes down to risk and what are risks out there. If I need something soon, cash is fine for me. That lack of return is an insurance policy that I have the money when I need it. If I don't need that money anytime soon, I think cash can hurt you because although inflation is low, it is there. So as that one chart showed, if I make $220 on $100,000, I'm still $1,500 under what I should be earning just to keep up with inflation. So over time, inflation will eat away at the value of that. So if you're concerned and you have cash, we certainly would suggest you start dollar cost averaging, just add slowly into the market.
So potentially buy on some dips as the market gives those to us on a daily basis.
Yeah, or just systematically. It's going every 15th of the month.
Rich asks, can you explain the TINA effect again?
Yeah, sure. So basically, there is no alternative, TINA. So right now, people are buying. There's a thought that the effect is saying, well, because Joe's earlier question, if I sat in cash and they're literally giving me nothing, I'm not earning anything. It's 0.02. The Fed has said we're not going anywhere for a year or two. The no alternative is buying stocks or looking at equities or looking at things other than cash, because it's a tough place to be. Yes, you can go up and down in stocks, but I'm getting a dividend and at least my money has a shot at it. Whereas if I sat in cash, from what the Fed says, for 2 years, assume I'm going nowhere.
All right. This is a first in a virtual experience, but Paul Puma has a question. Paul, I'm going to unmute your mic and allow you to talk to Morgan. So, Paul, if you want to unmute.
There we go. Hey, Morgan, how does the ever-increasing deficit play into the stock market? I mean, we just keep going further and further in debt. How do you feel about all that?
We need to fix that. I mean, it's bad. And as I said earlier, like I showed that right now it doesn't matter in that the velocity is not spinning. So all the money
Right.
It's not turning into inflation. Frankly, the government would love inflation because they're paying back the debt with cheaper dollars.
Mm-hmm.
I think that it's something that has to be dealt with. You look at Japan and their GDP, a good part of it is debt, and so it's getting out of control, and we have to rein it in. But I don't think that anyone will do anything for a while with it because of the need for stimulus. The economy can't handle that right now. But we should be, because at some point we're going to have to pay for it. And I don't know how we do it or what we do with it. But you got to understand too, if you look at a value of a stock, there's a term ROE, return on equity, and the last part of the equation has debt. And so, granted, you don't want too much, but the market likes debt because you can lever your returns. So the market doesn't mind debt. The bond market, which is larger than the stock market, would have more of a concern there because they're worried about payback.
So Biden, Trump, no difference?
No, I mean, the market is based on market actions. The market is not so much concerned. The market is taking positions right now that solar ETF is doing quite well, and that's a thought that Biden will win.
I'm sorry. I meant on the the deficit, improving the deficit?
No, I don't think either will do anything, because I don't think they will. During the Trump administration, they've had to spend because of what's going on right now. So no, I don't see either attacking the deficit, and especially their first year, whoever's in their first year in office. I don't see it, and that might bleed into the second year. Because of where the economy is, where there's a massive amount of people that are unemployed, and they're trying to solve that.
Thank you.
All right. Perfect. Thank you. Great question. We're going to go to Mike now. Mike's asking Morgan, is the market overall currently pricing in a second stimulus package? Curious if you're taking risk off the table or putting more on it this time.
Yeah, I think they are. I think that the market is pricing in a second stimulus. Earlier today, 300 points, because it looks like it's not happening right now. So they're certainly pricing that in. It'll happen. They're stalling it. And when that October date hit, when everything was running out, you saw the market reacting to it. So are we making? No, not so much. I mean, we made some moves a while back in anticipation, added to our growth and our some of our dividend payers and our biotech and a few things. So we've made some of our moves. What we're doing in our moves right now is actually doing a lot of rebalancing, trimming things. We've made some good growth in some areas. I mean, if you're sitting on some Apple, I'm not saying that Apple's going away, but it's, certainly trim some of those things. So to that extent, yes, we are making moves to clean things up, trim things down. But I think ultimately we will have some kind of stimulus. But I think if we go through this and don't have a contested election, I think the market will be just somewhat happy to have it done, because then regardless of who's in there, you can make plans for it. So, okay, we know what's going on right now. The market doesn't know. So you can't, you just make certain moves, and the market hates uncertainty.
Okay, good. Great answer. Phil, he's asking, we're seeing examples of Amazon and other retailers utilizing excess commercial properties for fulfillment centers. For the commercial REITs to rebound, is there enough of that type of potential demand, or do some developers need to start looking at other alternatives for that real estate?
Yeah, but you also had, you had a lot of retail going away, and they were filled up with 24-hour fitness and a bunch of gyms, and all those gyms are not there. So yes, some of those big fulfillment centers are being filled. They're making changes to some of those. They're doing different things with some of those. So yeah, I think they have to get creative. They have to do other things with those, because you're going to have a lot of big boxes out there that need to be filled. And Amazon is a good alternative, but just drive up and down the 405 freeway. I mean, how many malls do we have? How many large office spaces do we have? So they will have to get pretty creative, and they'll do something. I mean, that's the one thing about what we do here in America is we get creative, and there'll be changes to it, but it'll take some time. And but right now, because I don't know where this all settles yet. We still are. We're waiting for the second stimulus. We don't have a vaccine yet. People aren't back to work. When the fog clears and we, wake up sometime in 2021 and go, okay, everything's good. We're back to normal. What is normal? What does it look like?
Okay. Andrew, I've got a question for you actually, because we've talked about this in the past, but it's about cash alternatives. So it's been touched on in a few different ways. And Mike asks, he's like, where do you keep your emergency fund money? Does the FDIC insured and liquidity on high yield savings account, does that still make up for a paltry 6.6% interest? I know you've been working on something here at Spinnaker that we partnered with as well.
Yeah, I was going to bring that up actually in the close, but thanks, Mike, for the question. Unfortunately, because the Fed has rates at close to zero, yes, it is still around that 0.6%. However, we do have a savings account option that we just brought online here at Spinnaker. So call your advisor, Joe or Morgan, about that. But basically, it's paying on the first 500,000, 70 basis points. So a little better than your 60 basis points there. And you actually get better FDIC insurance because they split it up over 8 banks. So as a single person, instead of getting the 250,000, you'll get $2 million in FDIC insurance. So we'll give you more information on that if you want to, but there are slightly better options out there than the account you're currently in.
That high yield still seems to be a good option when it comes to emergency fund cash. So, okay. Morgan, at the beginning of the presentation, you talked about bonds doing well. I guess maybe that's, you put it how you want, but the question's basically saying, I don't understand how less than a 2% return is good. How do you make that up in a market, given where rates are right now? At less than 2%, how do you make money buying today's treasuries? Or maybe they're asking, what about corporate bonds?
You don't. Bonds, if you bought them today, aren't great. You did well in bonds because interest rates went down. Again, rates down, values went up. And just like I showed that duration where it went this way, well, the opposite happened. You could buy a 30-year bond, interest rates drop, and I could be up 15% in bonds. So bonds have done well. But now going forward, it's tough, especially if you're in a treasury bond fund. You're going to be sub 1%. So if you and it still doesn't mean you bail, and it may be a long time before you get above that. So maybe that's a decent rate. But we like the corporates over government, higher quality corporates, because you're going to get a percent or so over what the Treasury's giving. And then if you're comfortable, some of the high yields too. I mean, you have to be careful in some areas. The government went in and bought some high yield ETFs, so they almost put a safety net under them, and that's not going to necessarily continue, but there is some moral hazards to that, but that's an area also. So if you're going for yield, no, I mean, the bonds are just there because they're better than cash.
Okay. So it's a cash alternative, essentially.
Yeah.
In cash. Are you buying corporate bonds today?
We're doing it in fund form. We're finding it's tough to find individual corporate bonds. The big guys out there take down everything. PIMCO, it's tough to find the individual bonds.
Got it. Well, I think this is evidence to me why people are working with us. I mean, that was all clear as mud, right? So working with a team like Spinnaker,
thanks.
You don't have to, but you get into the bond market, it's incredibly complex. So I think when you're talking to the wizard, it's often good to remember that we're here looking out for your best interests and do what we can to help you make money in the market that we're in today. So you focus on what you're good at, we'll focus on what we're good at, we'll make you money, you keep earning the money. We'll do that. Morgan, do you want a final word before we turn it over to Andrew? I don't see any more questions. So. No,
I would just, we're always going to have something out there in this world that's going to happen that we're going to be concerned with. But I certainly wouldn't be making big decisions because of the election coming. Like I said, I would be looking to the future. I'd be probably more concerned as we go into 2021 when, stimulus ends and everyone gets back to work if there's jobs. So thank you all for attending though.
Yeah, awesome. Well, thank you, Morgan. Andrew, the floor is yours. Andrew is our technology guru here at Spinnaker. So if you see any new tech stuff coming out of Spinnaker, whether it's the app or whatever, Andrew's usually behind it. So
I'm trying. But yeah, I just want to elaborate a little bit on what Morgan said, and I hope everyone enjoyed diving into the details today. But these are hopefully meant to just broaden the communication, emails, the Zoom call, inform you guys on what's going on in the market and the economy. This isn't meant to necessarily go out and make moves today. It's just to keep you educated, stay focused on the long term and the plan. The day-to-day, the newsreel, it's going to be consistent. We got our finger on the pulse on it for you, so you guys don't have to worry about that. On the technology front, we are trying to improve a lot on that. So if you need help getting logged into the client portal, our planning software, our high yield cash option, let us know. We're happy to help you guys out and get set up on that. If there's something you want to see, also please let us know. We're looking to build partnerships and bring new features to our clients. So thank you all for joining us. It's going to be an exciting month. And to that end, we go to work for you guys.
Cool. All right. Thanks, guys.